So I'm assuming that you know the basics of supply and demand, including consumer and producer surplus, and we're going to analyze the effect of taxes. So when we do taxes, we're assuming that we have an excise tax, which just means a per unit tax in dollars. So for example, every time you buy a good, you have to pay $1. Every time you sell a good, you have to pay $1, as opposed to a percentage tax like an income tax. So it just makes it a little easier to deal with in terms of the graphs. The logic would really be the same. So anytime you see a tax in micro, we're talking about these per unit excise taxes. So first we're going to put the tax on sellers. So sellers are going to be responsible for paying this tax, and what that does is, remember, your supply curve is your willingness to sell at particular prices, and if sellers are now going to have to pay this tax, and this vertical distance is going to be the dollar amount of this tax, same as this distance here, so P2 minus P3 is the size of the tax. And so if they were willing to supply Q2 when the price was P3, well, then if they're going to have to pay the tax, they're going to need an amount higher by the amount of the tax for them to still be willing to supply that amount Q2. Because if they receive P2 and then they pay the tax, they're actually getting P3, and at P3, according to their supply curve, they're willing to supply Q2, and the same thing for every quantity. So at some particular quantity over here, they would require this price to supply that quantity. Well, if they're going to have to pay a tax, then the price has to be higher by the amount of the tax, and so that's why we're shifting the supply curve up. So it's like adding a cost to suppliers when we add that tax, which is one of the things that shifts our supply curve. So adding that tax shifts up vertically by the amount of that tax. And as we can see, just basic supply and demand tells us that we have a new equilibrium over here at P2. And so what we want to do is just analyze what's actually going on after we account for this tax. So here I just labeled some of these prices because what's going on is that the new price is P2. So buyers are paying P2, sellers are initially receiving P2, but remember they pay the tax, so they're really receiving P2 minus the tax, which is down here. That's why I label this as these are all after tax effects. So the sellers are receiving P3. Buyers are now paying that, just the new equilibrium price. They're just paying that new price. They're not directly responsible for the tax. However, we can see the whole point of this analysis is that they're going to be sharing the burden of this tax. So even though we put it directly on sellers, buyers, they were paying P1, now they're paying P2. So buyers are worse off and sellers are worse off. So despite the fact that we only put the tax on one side, both sides, buyers and sellers, are sharing the burden of the tax. Suppliers would like to be able to pass on this entire tax to sellers, to buyers. Sellers would like to pass on the tax to buyers, but this market will not allow them to do that because the demand curve is downward sloping. So sellers might say, get together and say, hey, let's just put the price up here because we're going to pass on the full tax. Well, based on these supply and demand curves, this is not an equilibrium price. So the new equilibrium goes to here. In other words, at this price, buyers don't want to buy that much, right? So we have to move down that downward sloping demand curve. Buyers are buying less as the price goes up. So sellers are unable to pass on the entire tax to buyers. They are sharing the burden of the tax. And it's going to be the shape of the supply and demand curves that determines the actual burden. In this case, because I drew it symmetrically, or at least it looks like it's pretty symmetrical here, it looks like they're both equally sharing the burden. We're going to change that in a minute or so. So in this example, we had the tax put directly on sellers. We're just going to change that and put the tax on buyers. So buyers are now responsible for paying this tax. However, it's going to be administered every time you buy something. You're going to have to pay the government $1, $5, whatever the tax is. And so the same kind of reasoning tells us that if buyers were willing to buy this quantity when the price was whatever that price is, well, then for them to be able to be willing to continue to buy that quantity, the price is going to have to be lower by the amount of the tax. And at some quantity over here, in order to be willing to buy that quantity, the price had to be here or lower, and so it has to be lower by the amount of the tax for buyers to continue to still want to buy that quantity, so that's why we're shifting the demand curve down. Their willingness to pay, in other words, is now lower by the amount of the tax. And so what's the effect of this? The new price here before the tax, or the new equilibrium price, is P3. But remember, so buyers are paying P3 initially, but remember they're paying the tax, so it's really P3 plus the tax, which is why price that buyers pay after tax is here, and sellers are just receiving that new lower price. So again, we put the tax directly on buyers, but they're sharing the burden. Sellers are worse off, they're getting a lower price. Buyers are worse off, they're paying a higher price. They're sharing the burden, and in fact, the result is exactly the same. So one of the results of this analysis tells us that it does not matter which side we put the tax on directly, because supply and demand is going to determine the burden, and in this case the result is exactly the same. In this case we shifted the supply curve, we ended up here, but the price that buyers pay was higher, that price higher than P1. The price that sellers received was that price lower than P1, and we had the exact same result over here. Right, new price, but this didn't really matter so much, that our new equilibrium price, because the after-tax effect is the higher price is being paid by buyers, the lower price is being received by sellers, exactly the same result that we had here. So that shift really did not affect the true burden of the tax. So that's why if we draw a tax, it doesn't really matter which assumption we use. So we could put the tax directly on sellers, the tax directly on buyers. In other words, the law or the administration of this tax does not affect the economic burden. So that's why if we want to draw the effect of a tax, we can even leave out these shifts. So that's often the easier way to do it. So I kind of drew these as faded dotted lines here. We could have done this by putting the tax on sellers, in which case that's our new supply curve. We could have put the tax directly on buyers, in which case that's our new demand curve. But it made no difference. Either way, we're putting in this tax wedge here. So this is the size of the tax. We're kind of wedging this into our supply and demand curves, and that's what causes the effect of this, or shows the effect of this tax. Because either way, whether this is supply or demand shift, that higher price is the price that buyers pay. Again, they're worse off. The lower price is the price that sellers receive. They're worse off. It didn't make a difference when we put it on directly, so we can just leave that out, and just, as long as we know the size of the tax, we're just going to wedge it right in there. It's called the tax wedge. It now creates a wedge between these two prices, the price that the buyers pay and the price that sellers receive. In an ordinary market, there's no wedge. Right, so forget this tax, we're just over here. The price the buyers pay is the same as the price the sellers receive over here at P1. As soon as we add a tax, we create a wedge between these two prices. So if the tax was bigger, I would just put a tax wedge over here, and it would be there. And so the size of the tax affects obviously how much quantity we're going to lose here, and as well as the change in surplus. So what's going on here is that consumers are worse off, as we already saw, because of the higher price, but now we can look at it in terms of consumer surplus. So we had consumer surplus of A, B, and C without the tax. Once we have the tax, the price after tax is P1 that buyers are paying. So these numbers should be different, but you can see what I mean. Buyers are left with just this surplus of A, this consumer surplus of A. Sellers had surplus of D, E, and F without the tax, and with the tax they're actually receiving P3, and so they're left with this surplus of F. And B and D is going to be tax revenue, right? Size of the tax times the new quantity. So the tax shrinks this market, right? We're losing transactions because we're being taxed here. So the new number of transactions times the size of the tax, that's how much money the government is raising. That's the tax revenue, B and D. C and E are deadweight loss, right? That's the lost surplus as a result of taxing this market. We have lost mutually beneficial transactions, assuming we were at the efficient amount before. So in other words, assuming there's no externalities, which we'll do later. But we have no reason to doubt that would be the efficient amount. People are willing to pay this much for these extra units. Sellers were willing to sell it for this much, and so these were mutually beneficial transactions. This was consumer and producer surplus that was being created in this market, and because we've taxed it, these transactions no longer happen. This surplus no longer happens. So that's our deadweight loss. This is why this tax is going to be is inefficient, because we have this deadweight loss. So the more transactions we lose, the bigger this tax is, the more deadweight loss you're going to have, and so the more inefficient the tax is.